Hi everybody, this is Ellman, the Blue Collar Investor, with today's covered call writing question of the day. Today's question comes from Leo. Hi Alan, I just recently subscribed to your site and I'm still going through your many videos. I noticed that in your covered call strategy, you don't mention the Greeks much. Is this because they are not that relevant in covered call writing? I'm under the impression that you never know the Greeks too well because of other strategies. Thanks, Leo. Well, Leo, you're correct in one regard. I don't specifically harp on the specific Greek statistics. However, I do feel that it's critical that you understand the basic concepts behind the Greeks. And that's why I do devote a good number of pages in my latest book, The Encyclopedia for Covered Call Writing, and in my DVD program regarding these concepts. But you are correct that I don't harp on the specific statistics of the Greeks, and you don't have to look them up. So to explain this, let's start off with defining a few terms for those viewers out there that may not be familiar with the Greeks. In the screenshot in front of you now, you could see that I've defined Greeks as mathematical factors that allow us to estimate the risk of the options. And there are several Greeks. The three that apply the most to covered call writing, I'm going to define for you now. First, there's delta, which measures the change in the price of an option for every $1 change in the price of the underlying stock. So if an option has a delta of 1 and the stock price moves by $1, that means the option price will also move by $1, up or down. Theta measures the change in an option price due to a 1 day of time passing. So what happens is the time value of the option will decline a certain amount for every day that passes, so it's a negative number. And finally, we have vega, which measures the change in an option price due to a 1% change in the volatility of the underlying security, or the implied volatility. In other words, what the market is anticipating in terms of a price change in that underlying stock. So those are the main Greeks that we look at when it relates to covered call writing. Let's take a look now with what you need to know about each of those Greeks. We'll start with delta. Now, as we said before, delta measures the probability of an option expiring in the money. In other words, it changes a certain amount for every $1 change in the price of the stock. So basically, a delta will tell us what is the probability of that strike price ending up in the money or lower than the market value of the stock by expiration Friday. Here's what you need to know. In the money strikes have the highest deltas, approaching 1. At the money strikes, you buy a stock for 50 and you sell the 50 strike, have deltas near 0.5. And out of the money strikes have deltas near 0.1 to 0.2. The lower it gets, the further out of the money the strike price goes. So we know that option premiums will decline nearly dollar for dollar with deep in the money strikes. That means that if the price of the stock is declining and you hold an in-the-money strike, or you've sold an in-the-money strike, you could buy it back cheaper because the price of the option is declining dollar for dollar. Now, what do we need to know that for? Well, if you're a conservative investor, or if you assess the market as being bearish or volatile, or if you just have a very low risk tolerance, selling an in-the-money strike will give you protection and allow you to buy back that option at a lower price because the option value is declining faster from an in-the-money strike. All right, let's next turn to the next Greek that we want to discuss, and that's theta. And once again, that's the amount that an option price will decline for every 1 day that passes. And that's what's going to happen to the time value of an option. It will decline just by the normal passage of time. It's almost like if you bought a car and drove it out of the showroom, and automatically the value of that car will depreciate in value. Same thing with an option, and that's why I'd rather be the seller of an option rather than the buyer of an option. But that's my personal preference. So another thing you need to know is that theta, or the erosion of time value, will increase as you get closer to expiration Friday. And the time value deterioration is not linear. It's not a straight line. It's logarithmic. So what that means is at the beginning, the time value will start off slowly as far as erosion is concerned, and then as you get near expiration, it'll basically fall off a cliff. Well, what does that mean for us? It tells us that if we're selling 1-month options, we should sell them early in the contract period so that time value erosion will not rear its ugly head as it does towards the latter part of the contract. It also tells us that because of time value erosion, we'll be able to buy back that option if we need to institute an exit strategy later in the contract, because the cost of that option will decline as you approach expiration Friday. And let me show you a chart or a graph of what that time value erosion looks like for a 1-month option. And you could see on the left side of the graph, time value erosion starts off relatively slowly, and at the very end, it just drops off a cliff. So we're going to want to sell our option early in the contract, and we'll have an opportunity to buy it back at a lower price later in the contract. Once again, we don't have to look up the specific statistics for theta, but it's important to understand the concept behind it. Okay, we have one more to do now, and that is Vega. And Vega talks about the price change in an option because of the volatility or the implied volatility of the underlying security. The higher the volatility, the higher the premium. Now, on first blush, that sounds pretty good. More money for us. However, the higher the volatility, the greater the risk. Now, we are basically conservative investors if we're using the strategy of covered call writing. To me, it makes no sense to take a highly volatile stock and sell a call option on it. You know, if you're a conservative investor, you want to stick to that conservative modality. So you have to define what your sweet spot is in terms of your initial return. Mine is 2 to 4% a month. That's my goal for my initial return. And as far as a high premium, well, the guideline I use is that if an at-the-money strike for that security generates more than a 6 to 7% 1-month return, that tells me that the implied volatility in that option is very, very high. Therefore, the risk is very high. Therefore, I pass. And I know to some it may not make any sense. Why not grab as much option premium as possible? But the answer is we have to balance between our option return and the risk we're willing to take. So once again, for me, the initial return, 2 to 4% is my goal. I'll go a little bit higher, but I won't go much past 7% for an at-the-money strike. Now, with all that in mind, hopefully you have basically an idea of the BCI methodology as it relates to the Greeks. Just to summarize, it is critical that we understand the concepts behind the Greeks as far as our trading and management is concerned. However, it is not necessary to go look up the specific statistics of each option. So hopefully now all that is no longer Greek to you. Hopefully you've benefited from this video, and thanks to Leo for asking that question. If it wasn't for him, I wouldn't have thought to discuss this matter. And thanks to all of you out there for viewing this video. I hope you enjoyed it. I hope you find it beneficial. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.